Tom Lee says to buy the effing dip. Literally, that's what he said. If a dip does indeed come, because there are positive tailwinds for equities. These positive tailwinds to equities would be earnings reaccelerating, specifically for your small and mid-cap areas, inflation continuing to fall, and the economy hopefully staving past a recession. Not to mention something Tom Lee points out all the time, you have $6.4 trillion currently sitting on the sidelines in our markets in money market funds. When the Fed does start to cut rates, I believe as soon as July 31st, then that will start to pull a lot of that money off the sidelines and back into equities. And what would make sense for that $6.4 trillion to do is to go into areas of the markets that will benefit from whatever is going on at the time. If the Fed starts to cut rates into a strong economy, that's going to be small caps and mid cap stocks, maybe some of your AI stocks as well. If the Fed is cutting rates because the economy is, weakening, then a lot of that money could go into something like a TLT. It could go just into long duration bonds or into Magnificent Seven stocks. Now, I do want to play this clip from CNBC. I think this is a fascinating take on the current state of the labor market, not something you hear all the time, and why inflation is likely going to continue to decelerate. And indeed, we could actually have a problem where we see too much disinflation, maybe even deflation over the next 12 to 24 months, rather than risk reaccelerating inflation.
We're in the markets right now. We want to bring in Jim Paulson. He's the author of the newsletter Paulson Perspectives and former chief investment strategist for both the Leuthold Group and Wells Capital Management. Jim, we've been watching the markets. We are sitting either at or new highs, depending on which one of the major averages you're watching. We've seen a lot of momentum to this point. How are you feeling about things?
I feel pretty good, Becky. Thanks for having me this morning. I think there's a lot of things that are going right here. We got an economy that was supposed to be dead, 18 months ago to recession from a inverted yield curve, among other things, but it just keeps going, and it's looks pretty healthy to me. Balance sheets in the economy are really healthy. Liquidity is healthy overall. So earnings, we just had another good earnings quarter, so I feel pretty good. I think the market is, or the economy is going to slow down, Becky. I think that the policies have been tightening, whether you look at higher yields than last year, stronger dollar, a lower fiscal deficit to GDP ratio, kind of modest monetary growth traction of the Fed balance sheet. That's going to come home to roost to slow the economy and slow inflation. So I think we're finally going to embrace the idea of a soft landing, and we're going to take inflation in CPI terms below 3%, and that could set off a lot of very positive forces for the market. So I think there's still more upside room here.
Yeah, it sounds like you think we are far more mid-cycle than late cycle, like some of the guests that we talked to.
I do, Becky, and I think that it's been difficult to judge how old this cycle is because the unemployment rate's been below 4% for 2 years. And typically, you get the unemployment rate that low, you're close to the end of the cycle. You just run out of labor. But the reality of what's going on is, in the last 2 years, the unemployment rate has been understated because every month the labor force is growing, and so new entrants come in, and they're keeping the job creation going with fresh new entrants that weren't even considered in the labor force. So I think the unemployment rate is really higher than it is being reported. The labor force is about 2% higher than the previous recovery peak level, and it's generally gone up 5% or more in almost all post-war recoveries. So I think there's still elasticity to the labor force. And if that happens, I think that we've got a ways to go before we run out of resources and the recovery is over. I think it's relatively middle age, not old age.
But you're not worried about inflation. You think it's going to come back down. There are a lot of things that are pushing and kind of maintaining that steady, keeping it higher. I mean, what you're describing sounds like the perfect scenario. I'm trying to think of things that would throw off that scenario or that might be more reason to give a little pause.
Well, I think that the problem, inflation has come down a lot, 9% to 3%. Wage inflation from 6 to under 4. The problem hasn't been inflation coming down. It's been coming down. The problem has been It hasn't come down to the 2% Fed target. I'm not sure where that came from, that's been declared nirvana. I don't think we have to get to 2% to have things be good. And I do think that that the tightening policies that we've had in place now over the last year, including mortgage rates and the 10-year yield going from 3.5 to 4.5, that's going to slow us down. I think we're already seeing some evidence of that. I don't see how inflation from here is going to go a lot higher. I mean, could it persist, a month in bad report here or there? Yes, but I don't think we're at a great a risk of that. And it seems like we've created this narrative of we're at such risk of inflation. I think the risk is long gone quite a while ago. And if anything, we're probably going to have more risk of it turning out much weaker than expected here over the next year, for example, rather the other way around. I'd be more about recession than I would about inflation.
And that's why you think rates have peaked here?
I do. Yeah, I look at rates. I think that if you look at the 10-year yield, it went up with the inflation rate when the inflation rate went from 0 to 9%, but that has not come back down as inflation's come from 9 to 3. It went up with commodity prices when they went up, but it has not come back down when commodity prices have come back down. If I look at the 10-year yield at 4.5%, it's now about 2% above the dividend yield on the competitive alternative of the high dividend S&P high dividend yield index in the S&P. It used to trade at a discount over much of the last 10 years. So I just think in many ways the 10-year yield to me is looking very high. I think we're going to have a pretty good rally in the 10-year. I wouldn't be surprised if we see much closer to a 3% yield than 4.5%. Maybe sometime before the year's out or over the next year.
Now, what happened to equities today was kind of multi-sided. On one hand, some investors are saying, hey, we should sell stocks before a potentially hot PCE report comes out this Friday. On the other hand, we did get some better than expected data out of the service sector. Richmond Fed Manufacturing Index, first and foremost, came in at 0. We were expecting -6, so that was better than expected. Richmond Fed Manufacturing Shipments came in at 13. We were expecting -9. And Richmond Fed Services Index came in at 3. We were expecting -12. So all of these came in better than expected. Great news for the economy, specifically that Richmond area, but maybe bad news for the Fed and inflation. I do think the market's overreacted quite a bit to some of this data that came out today. Dallas Fed Services Index came in at -12.1. Estimate was -10. So service activity is down more than we thought around the Dallas area. But Dallas Fed Services revenues came in at 6.7. The estimate was 0.3. So that was a big upside surprise, potentially in pricing of services. We also did have a 7-year bond auction that came in at 4.65%. The last auction we had was 4.71%, so this was a decline from the last auction, but we were expecting this yield could come in closer to 4.6%, so that did put some upward pressure on bonds, which you can see today. 10-year treasury yields were up about 10 basis points at one point today. That's a lot. That's almost half of one rate hike from the Fed. That's a big move in any year or day for that matter. 10 basis points in a day is was unheard of in the past 20, 30 years. Now we do that every couple of days. It seems like 10-year treasury yields currently are up about 7.5 basis points, with the 10-year treasury yield at 4.62%. And this is also putting some pressure on equities as well. You also have Nvidia that continues to steal everyone else's lunch, even its own counterparts today. You can see SMCI is down about 4%, AMD is down about 4%, but look at Nvidia chugging along, up about 1%. And when you're in this kind of market where there's not that much new capital coming into stocks, these hedge funds, institutions, they're chasing Nvidia. Even retail, for that matter, at this point, is chasing Nvidia and the upcoming stock split. And basically, if you're a hedge fund or institution, you pretty much have to own Nvidia right now, because if you don't, your clients might leave. Right? If you're not invested in Nvidia, what are you doing? Right? That's kind of the overall narrative. So as Nvidia goes up 1%, doesn't sound like a big deal. It's like $30+ billion maybe more than that. Maybe my math is off quite a bit there, of money that is going into the stock today. And it's coming from other areas. Today, it's coming from a lot of other semiconductors and small caps as well. They're just continuing to get drained of liquidity. So I actually think Nvidia is one of the biggest drags on small caps, on mid caps, on average stocks today. You also have the dollar up about 0.5% today, and that's a big single day move for the dollar. And that puts pressure on multinationals that take in foreign currencies and convert that back to dollars. Basically puts pressure on company earnings as the dollar goes higher. It's actually better for companies when the dollar weakens. As you can see, that's what happened in 2020 and in 2021, and corporate profits did pretty good during that time. And this was 2022, where you had a 20% rise in the dollar, and that was a big headwind to stocks. So whenever the dollar goes higher, it actually looks like it's trending higher right now. You can pretty easily see this trend line. That's not great. That doesn't make investors feel good about the markets. Now, coming out tomorrow morning, we will get some huge data. You have your GDP growth rate quarter over quarter, second estimate for Q1. We're expecting this could fall as low as 1.3%. It was 3.2%. So if we do get a big fall like that, markets are going to nitpick whether it's inventories or exports, what the reason is why GDP does come in low and maybe lower than expected. They're going to peel it apart, the actual report. But if that number does come in lower than expected, that's bad news for stocks, right? No matter if the markets take that good or bad, you want to avoid a recession as long as we can. Tomorrow, you will also get initial jobless claims coming out at 8:30 in the morning tomorrow, expecting a number around 218,000. If that number comes in higher, markets might like that. But again, you don't want to see weakening in the labor market. You will also get real consumer spending, PCE prices, home data on a quarter over quarter basis, bunch of different things. Pending home sales month over month and year over year, highlighted in red here, expected to be a decent volatility catalyst, like a medium volatility catalyst. And that is pretty much it for tomorrow. You do have Fed Williams that speaks around noon and Fed Logan that speaks at 5 p.m. tomorrow. But your GDP number is really going to be the thing that dominates how the markets trade. Now, I will tell you, for anyone that's bullish on small and mid cap stocks, the fact that you are selling off heading into your PCE data on Friday or even heading into tomorrow looks a little bit better positioned for maybe a consensus PCE report or maybe a slightly hotter PCE report. Like, I don't think it's going to be as much of a surprise if that happens, or stocks are going to sell off nearly as much, because you're kind of already selling off into that event itself. It's like a company on earnings. If a company rallies into earnings, if they beat on guidance, if they beat on everything, a lot of the time, most of the time, that stock will still fall after earnings, no matter what, because you had already priced in all the good news. Well, if you sell off into earnings and you beat on guidance, you can get quite a large up move. And that's kind of the same way that I'm looking at markets right now. The more we sell off into Friday, the more likely it is we could see a big bounce back, especially in areas like small caps and interest rate sensitive stocks. The percent of stocks above their 50-day moving average today is falling to 43.11%. Over 5% of stocks out there on the markets today fell under their 50-day moving average. And I mean, that shows the Russell's down 1.5%, the Nasdaq's down almost 1%. Really, the only thing doing well is Nvidia. And if Nvidia was red today would be a much worse day. So actually, under the surface, stocks are getting pretty beaten down today. We do have some earnings coming out today and after hours as well that will be important, with Salesforce, C3 AI, UiPath, Okta, Pure Storage, HP, Agilent Technologies, American Eagle Outfitters, and others. Tomorrow, pre-market, you have Canopy Growth, Kohl's, Foot Locker, Dollar General, Maxion, Best Buy, Hormel Foods, Burlington, Birkenstock, and Build-A-Bear Workshop. Tomorrow in after hours, you will get Costco, Dell, Zscaler, Marvell, MongoDB, Ulta Beauty, Centennial One, NetApp, Viva, and Elastic that will all report earnings. So even though big tech earnings are over with, you still do have some specific companies that will be important. Dell will be important. Salesforce today in after hours will be important, among a couple of those other stocks as well. So let me know what you think about all of this information down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. And if you made it to the end of this video, thank you for watching. Enjoy the rest of your day, and I will see you in the next one.